Let's talk about a pretty wild idea. What if you could pull in $3,000 a week, every week in passive income? That's the huge claim behind a financial strategy making the rounds. And today, we're going to break it down. We're diving right into the source material to see exactly how it's supposed to work, and maybe, just maybe, if it's too good to be true. So it all starts right here with this quote, taken directly from the analysis that inspired this explainer. A staggering $3,000 every single week. I mean, that's an incredibly powerful number, right? And it's all built on a very specific, and I have to stress this, a very advanced financial strategy. So that's the big question, isn't it? Is this just a pipe dream, or is there a real, tangible strategy here? In this explainer, we're going to break down the analysis piece by piece. We'll look at the problem it's trying to solve, the key asset involved, the actual mechanics, and, you guessed it, the huge risks you have to know about. Okay, first things first. To really get this strategy, you have to understand the core problem it's designed to attack. The source material calls it inflation's financial assault. And yeah, it's as serious as it sounds. You know, the analysis makes a pretty bold point that the old playbook, work hard, save your money, invest it safely, is getting harder and harder to pull off. It calls inflation a direct assault on your purchasing power. It's a dramatic way of saying that every dollar you have sitting in a savings account is quietly being eaten away, losing its value over time. And this chart from the analysis really paints the picture. Look, even with the Fed targeting a rate of almost 4%, inflation is still forecast to hang around 3%. So what does that mean for you? Well, if your savings aren't growing faster than that 3%, you're actually going backward. You're losing money. And that is the central problem this entire strategy is built around. All right, so if holding cash means you're on a losing team, where are you supposed to turn? Well, that brings us right to section 2, your hidden reservoir of wealth. The source argues that for a lot of people, the answer is a massive asset they already own, but they aren't really using. And what is that asset? It's your house. Or, more specifically, the equity you've built up in it. According to the source, the average U.S. homeowner with a mortgage has something like $319,000 in equity, just sitting there. The analysis calls this a massive, often untapped reservoir of wealth. It's dormant capital, just waiting. And if you think that number is big, check out the scale of this thing. We're talking about over 35 times trillion dollars in household equity across the entire country. Trillion. So the central idea of this whole strategy is figuring out how to wake up that sleeping giant and put all that capital to work. So let's get into the nuts and bolts. Section 3. This is where we learn about the playbook itself, a concept the source calls equity recycling. So what on earth is equity recycling? It sounds pretty fancy, but the idea is actually kind of simple. You borrow money against your house at a certain interest rate, and then you turn around and invest that money into something that earns you a higher interest rate. The difference between what you earn and what you owe, well, that's your profit. That's the passive income. Okay, so how do you actually do this? The analysis points to 2 main tools. First, a HELOC, a home equity line of credit. Think of it like a credit card that's backed by your house. Or you could do a cash-out refinance, where you basically get a new, bigger mortgage and pocket the difference. The rates you see here are the cost of borrowing. And that's the first, absolutely critical half of the equation. Right, so you've got the money, now what? The strategy says you need to invest it in what it calls anti-fragile assets. Now that's a bit of jargon, so think of it this way. A fragile teacup shatters under pressure, right? An anti-fragile investment is supposed to get stronger under pressure. You're looking for things that keep generating cash flow, even when the economy gets rocky. And what does that look like in the real world? Well, the analysis points toward high-yield real estate. We're talking about things like fractional ownership in rental properties, maybe investing in private real estate debt, or specialized real estate investment trusts, or REITs. The one thing they all have in common is the goal, to generate an income stream that's bigger than the cost of the loan you took out. And that brings us to the moment of truth. Section 4, the arbitrage calculation. This is where we finally see the math behind that $3,000 a week claim. Let's see how it adds up. So let's just walk through this example straight from the source. They imagine you deploy $1.5 million from a HELOC. Okay, so the cost to borrow that money is about $117,000 a year. But the investment you made, It brings in 255 grand. So you pay back your borrowing cost and you're left with almost $138,000 in pure net income. You break that down and it comes out to about $2,650 a week. Wow, we are getting very, very close to that big headline claim. Now, I know what you're thinking. Those numbers look incredible. But hold on. Before you run off to call your bank, this next section is without a doubt the most important part of this entire explainer. A word of extreme caution, because the sources are very, very clear. This is not some risk-free magic button. Let me put this in the clearest terms possible, and this is coming straight from the analysis. This is not a get-rich-quick scheme. Period. The second you borrow against your home to make an investment, you are putting the roof over your head on the line. That is the fundamental, non-negotiable risk here. And the analysis flags a whole minefield of ways this can go sideways. Your HELOC has a variable rate? Well, it could skyrocket and wipe out all of your profits. The market could crash, leaving you with a massive loan and an investment that's worth a fraction of what you paid. And unlike stocks, you can't just sell these things in a day. That's liquidity risk. The source is blunt. If you don't do deep, exhaustive due diligence, this can be financially devastating. And all of that brings us to this final, critical quote, pulled directly from the source material itself. This analysis is for educational purposes only. It is not investment advice. This isn't a recommendation. It's not a suggestion. It's an explanation of a complex, high-stakes financial strategy, and that's it. So what does it all mean? What happens when these kinds of complex, institutional-level tools start showing up on Main Street? This strategy, it highlights this powerful, but let's be honest, dangerous idea, turning your home from a place you live into a kind of ATM. It's a concept that could, in theory, create incredible wealth, or it could lead to absolute financial ruin. And the razor-thin line between those two outcomes, it all comes down to a deep, powerful, and humble understanding of the massive risks involved.